For years, anyone buying a house bowed to the seller's demands. Now the math has flipped, and the leverage belongs to the buyer. The primary driver of this reversal is the cost of borrowing. Mortgage rates have settled right at an even 6%. Rates are staying elevated because inflation is still stubbornly climbing to 2.4% year over year. CPI, the Consumer Price Index, measures the average change in prices paid by consumers for a basket of goods and services. But while inflation holds steady, the labor market is cracking. In February, the economy lost 92,000 jobs. Fewer paychecks and 6% borrowing costs mean fewer people can actually afford to move. Existing home sales have dropped to just over 4 million units. This chart shows how 6% rates and sticky inflation translate directly to homes sitting on the market much longer. Sellers are watching their listings go stale. To get deals to the finish line, they are finally offering significant 5-figure financial concessions. Imagine you are buying a median-priced home for $400,000 and you negotiate a $10,000 seller concession. Immediately, you have to decide where to put that money, and the professionals around you will push you in opposite directions. Your real estate agent will likely suggest knocking that $10,000 right off the purchase price. Your mortgage lender will almost certainly advise you to use those funds to buy down your interest rate. Applying the exact same $10,000 to the price versus the rate creates two wildly different financial realities for you. Guessing wrong could cost you thousands in lost cash flow or trap your equity for the next half-decade. The math on the first option, the direct price reduction, is straightforward. You take the seller's $10,000 and lower the total cost of the house to $390,000. This permanently shrinks the total loan principal you owe to the bank from day one. Because the purchase price is lower, the 10% down payment required to close also drops by $1,000. This comparison matrix shows exactly how that translates to your budget. Dropping the price by $10,000 at a 6% rate lowers your monthly payment by only about $60. $60 is a very small return on a $10,000 concession. That is because the savings are spread out over 360 months. This strategy prioritizes long-term equity growth, allowing you to gain an immediate advantage by acquiring the property at a lower cost basis. A price reduction acts as an insurance policy if local property values dip, but it provides almost zero day-to-day budget relief. The alternative strategy is the permanent rate buydown. This involves buying discount points. Discount points are upfront fees paid directly to the lender at closing in exchange for a permanently reduced interest rate. Instead of lowering the home's price, you hand the seller's $10,000 to the bank to permanently drop your rate from 6% down to 5.25%. This chart clarifies the 3-to-1 advantage in monthly savings. The lower rate slashes your monthly payment by roughly $180. That is triple the day-to-day cash flow relief you get from the price drop. Over 30 years, keeping that lower interest rate will save you tens of thousands of dollars in total interest paid to the bank. But lenders rarely focus on the hidden risk in this strategy, the break-even timeline. To find out if this is actually a good deal, you have to divide the $10,000 upfront cost by the $180 you save each month. That math equals 55 months. It will take 4.5 years of continuous payments just to recoup the initial investment. If you sell the house or refinance the loan before year 5, you lose money. A permanent buydown mathematically punishes short-term owners. There is a third option heavily promoted by home builders right now, the temporary 2-1 buydown. This chart shows how it works. The seller prepays a chunk of your interest, dropping your rate to 4% in year 1, 5% in year 2, before it reverts to the baseline 6% in year 3. During that first 12 months, the subsidy provides the most aggressive level of immediate payment relief available in this comparison. Then, at month 13, the subsidy shrinks, and your monthly housing cost takes a noticeable step up. At month 25, the training wheels come off completely. You are hit with the full 6% payment. Taking this option is a direct bet. You are betting that your income will rise, or that market rates will fall enough for you to refinance within 24 months. The temporary buydown functions as a bridge, necessitating a concrete plan to refinance or increase income before the third year begins. These raw numbers only matter once you weigh them against your specific timeline and lifestyle goals. There is no universally correct choice here. The right move depends entirely on your timeline and your goals. This flowchart maps out the decision. You have to start by answering one question. What is your primary housing goal? First, consider the cash-strapped optimizer. This is usually a first-time buyer who just needs room to breathe in their monthly budget. If cash flow is tight, the permanent rate buydown offers the highest return, adding $180 a month to your usable income. Next is the short-term strategist, who will move or refinance within 4 years. This group should choose a price reduction or temporary buydown. Buying permanent points means selling before hitting the break-even mark, wasting the seller's money. Finally, the equity maximizer. This move-up buyer plans to turn the property into a rental or has ample cash reserves. For them, a price reduction is the clear winner. A lower cost basis builds a permanent wealth moat and insulates against market corrections. Never negotiate based on what sounds good in the moment. Run the break-even math and negotiate based on exactly how long you plan to hold the loan. In a market stalled by 6% rates, your leverage comes from weaponizing the seller's concession to protect your specific financial future.